One question. Buffett in 99 said that if he was running very small amounts of money, he would be able to find lots of bargains and beat the market by 50%, and he would use the word guaranteed. I presume he meant that there are a lot of inefficiencies in the small capitalization stocks. One thing that kind of surprises me is if an analyst willing to work hard on his own, not in an institution, the world of distressed debt investing is kind of shut out, even for the value investor, filled with a lot of technicalities, and seems like the big institution has a lot of advantage there. Are there such inefficiencies that are kind of shut out to the institutions, but the small investor willing to work hard can find inefficiencies in the debt world?
Well, I think that the small guy can even be active in distressed debt. He can't get enough bonds to get a seat at the creditors committee table or have a voice, but he can still find superior values. What I was saying in answer to your question is that if you get some accounts and you have good performance, you'll get more accounts. So that goes a little further, because what I really say is that if you have good performance, you'll get more money. And eventually, if you let that process become unchecked, if you get more money, you'll have bad performance. And this is one of the conundrums in our business. And so you have to halt that. But the truth of the matter is that the little guy has an advantage as long as he's willing to stay small. Many people are not, because in the short run, the more money you manage when you get fees, it's a great lure to take on more money, but you have to stop it at a point where before it starts ruining your performance. Now, for the data scientists among us, I always like to point out that if I worked at Firestone tires and I developed a new tire and I wanted to know how far it would go, I would put it on a car and run it until it blew up, right? That's called destructive testing. But as an investor with clients and a fiduciary responsibility, I don't have the luxury of doing destructive testing. So I can't add more. People always say to me, well, what's the limit on how much money you can invest well? And I can't find out by running into the wall. I have to stop this side of the wall. One of the interesting lessons is that if you stop this side of the wall, then you never find out where the wall really is. But that's what we have to do. And so you have to stop. And I believe that the person who has a big brain and a little money and a lot of time and exceptional insight can find great bargains. But that's a pretty daunting list. And I don't think that Buffett's guarantee necessarily extends to everybody in this room.
Do you see any unhealthy trends in valuation in the market today, the same way tech or housing was valued in the past?
Yes, I do, because the market extends the menu, extends what we call the capital market line, extends from what's called the risk-free rate. The risk-free rate is the rate, generally speaking, on the 30-day Treasury bill. And of course, if you can get 3% on the risk-free rate, then in order to tie up your money for 5 years, in a 5-year Treasury, you want 4, and to get it 10 years, you want 5. And if you can get 10 years on a government security, a 5%, then in order to go into a corporate security, which has some credit risk, you would demand 6. And to go into a high-yield bond, you demand 12, and so forth. So there's a kind of a process called equilibration, which makes things line up in terms of relative risk and return, but always pegged from the risk-free rate. Today, the risk-free rate is 0. So everything that I just named, this capital market line has had a parallel downward shift. And so before the crisis, I had, Saurabh mentioned about the fact that I turned bearish. All my money was in treasuries. All the money that I had outside of Oaktree was in treasuries. And I was getting 6.5% for 1, 2, 3, 4, 5, 6 year maturities. I was getting income and safety. Today you have a choice, income or safety. Because the things today that are highly safe pay no income. You know, and if you go to Fidelity, conduct an experiment. Go to Fidelity or Vanguard or a big mutual fund firm and go online and look at their menu of offerings and what is the current yield, the current net yield after fees and expenses. And you'll see that for money market and short-term treasuries and maybe intermediate-term treasuries, the yield is 0. So just think, the guy is watching the Super Bowl in his undershirt. He gets a statement from Fidelity. He opens it up, and it says, the yield on your fund is now 0. He grabs the phone. He calls the 800 number. He says, get me out of that fund that yields 0 and put me in the one that yields 6. And he becomes a high-yield bond investor. He has no idea why. He doesn't know what a high-yield bond is. He doesn't understand what the dangers are. He doesn't understand how to pick a high-yield bond manager. But he's seduced by that 6% versus 0. And all around the investment world today, people are chasing return. They don't like the low returns that are available on safe instruments. They're going for the gusto. They're going for riskier instruments, and they're doing it mindlessly. And I promised you I'd mention some memos. I forgot to do that. But if you go back, I wrote one in March of '07 called The Race to the Bottom. And I talked about the fact that when people are, number one, eager to invest, and number two, not sufficiently risk conscious, they do risky things. And when people do risky things, the market becomes a risky place. And that's why Buffett says the less prudence with which others conduct their affairs, the greater the prudence with which we must conduct our own affairs. And that is going on now to some extent. Because people can't get a good return from safe instruments, they're going into the risky ones, and they're bidding, you know. So there's a race to the bottom. It's like an auction. Now, if you want to buy a painting at Sotheby's, there's an auction, and the painting goes to the person who pays the highest price. But in the investment world, it's a reverse auction. Well, sometimes you pay highest price, but sometimes you bid in lowest return. So there's a bond that's going to be issued by a company. I say, I demand 7% interest. And this fellow says, no, I'll take 6. And that guy says, I'll take 5. I say I want protective covenants to make sure that the company can't do things that ruins its own creditworthiness. He says, I'll do it with less covenants. And that guy says, I'll do it with no covenants. What happens? The bond is issued at 5% with no covenants. And that's the race to the bottom. And anybody who participates in that bond probably, could be making a mistake. And that's going on now. Not to the same terrible extent that it was in '06 and '07, but you got to be careful today. Oaktree's motto for the last 3.5 years has been move forward, but with caution. Caution has to be a very important component of everybody's actions today. Well, thank you very much for being with me, and I hope you enjoyed it. And when I think of more stuff, I'll come back.